So let's get into this. Will Biden's new tax plan threaten trust? I've had, as I said earlier, I've had multiple people hit me up, whether it's email, text message. I've had people call me, say, "You hear about Biden's new tax plan?" I don't pay attention to the public, but let's get into this. So, what is this from? I can't remember what this is from. Where is this from? Bloomberg News, right? Biden wants to dismantle two weapons the richest 1% use to avoid taxes. Provisions in the U.S. Treasury's Green Book proposal could disrupt dynasty trusts and other vehicles that have benefited wealthy families for years. And I know, a lot of trustees in training, people who've gone through trustee training, we utilize trusts, for asset protection, tax minimization, and to, overall reunify the family estate. And I get that, right? So there's a level of concern. But to me, and I'm not saying no names or pointing out anyone in particular, but for me, anyone asking this question of me, it just proves that you really haven't done your research. You're not doing yourself any favors when it comes to, looking at your materials that you received through training or doing any of the prerequisite information finding or fact finding. So I'll just go over it. And I want to bring it to those who are not in trustee training. Now, what are they talking about? The so-called Green Book is really the general explanations of the administration's fiscal year 2022 revenue proposals. It's about 116 pages. And I got it from the Treasury, U.S. Treasury Department website, treasury.gov. And it's basically goes through the proposals of revenue, different revenue proposals and stuff. Excuse me. It's not very exciting reading through this thing. And if y'all know me, y'all know that I don't really like to depend on secondary sources. I like primary sources of information. So I went to the source. I went to the so-called Green Book. I don't know why they call it Green Book. Maybe it's green. I printed it off on white paper. So, I mean, hey, that's just me. But this Bloomberg article is one of the articles that were sent to me. People send me stuff, man. Just text me stuff. They email me stuff. They email me YouTube videos. I'm going to let y'all know. The 99.9% of the YouTube videos that I'm texted or emailed, I do not watch. I don't have time to sit down and watch someone else's videos. I understand that people respect my opinion and respect how I look at things. But, I mean, it'd be better for you to text me a synopsis of, this is the video I watched and they were saying this and this and this and this. What do you think? Versus just sending me a URL to it. I'm not going to, no, it's not happening. But anyways, I did read the article because within the first couple paragraphs, I understood what was going on. But it's cool. So I'm going to break it down. No, I'm not speaking in any types of condescension to anyone. And of course, I'm not being pejorative in any way. It's not what I'm doing, but let's just get to it. So this is the article. An unpleasant surprise for wealthy Americans was lurking halfway through a 114-page document released by the United States Treasury last month. Technical provisions in the proposal not mentioned when President Joe Biden presented his plan to raise taxes on the rich in April could disrupt or dismantle some of the most popular ways super wealthy people have legally avoided taxes for decades. All right? I knew off top, the public cannot encroach on the private. There's a demarcation line that they just can't get past unless you just don't know what you're doing through your administration. But it's cool. One target is dynasty trusts, vehicles that wealthy families can use to benefit multiple generations of descendants. Another is an even more common tool among the top 1%, trusts that can move millions and sometimes billions of dollars to heirs tax-free. Quote, this is the stuff that's really going to make a difference. This is Joe Mayer, Director of Wealth Strategy at Johnson Financial Group, who went on to say it's going to make a difference in the anxiety that wealthy people and their advisors have and would really make a difference in the revenue the government collects. Biden's so-called Green Book, the Treasury document laying out the details, specifically takes aim at dynasty trusts, vehicles that are able to exist for generations without incurring gift, estate, or generation-skipping transfer taxes. The proposal would force trusts to pay capital gains tax on appreciated assets every 90 years, but it's drafted in a way that would impose taxes as early as December 31st, 2030. Appreciated assets. So you pay taxes on a house that has appreciated in value over a certain amount of years, whether you sold it or not, whether the trust sold it or not. And I understand that seems kind of freaky. Like, hold on, what? The change would cause planners to think twice about the strategy. This is James F. Hogan, a managing director at Anderson Tax LLC, who previously worked at the Internal Revenue Service. Quote, do you really want to do a dynasty trust when you know you're going to have an income tax anyways? End quote. Biden's plans to make heirs pay more, equalize rates between investors and workers, and boost taxes on corporations and the wealthy by raising rates are part of a global revival of initiatives to target the rich, a movement that has gained momentum since the panorama blew massive fiscal holes in government budgets, implemented new taxes on capital gains, inheritances, and wealth to raise money for social services and infrastructure. Biden's proposed plan would also charge a capital gains tax when assets are transferred into or distributed from certain kinds of trusts. Certain kinds of trusts. Dynasty trusts. Remember, y'all, there's over 80 different types of trusts. Over 80. A Treasury official said that aspect of the plan specifically targets tools like the intentionally defective grantor trust. Intentionally defective grantor trust. And those of y'all who understand, and especially trustees, know the IRS recognizes three different types of trusts: grantor, simple, and complex. Grantor trust, it's revocable. It's like an inter vivos trust. Think of a living trust. The best common understanding of a grantor trust. Intentionally defective grantor trust, a common, if complicated, technique that can allow the wealthy to move money out of their taxable estates to benefit heirs. Quote, that's a big blow to take that out of our arsenal. End quote. This is Ronald D. Alcutt, Senior Fiduciary Counsel at Bessemer Trust. The measures are designed to plug potential loopholes in Biden's plans to boost capital gains taxes on the wealthy to ordinary income rates and to tax gifts and large unrealized gains at death. And to me, this is the most appalling factor. They're going to tax unrealized gains. So usually there's a tax upon the sale of an asset for however much it was sold for. They're going to tax unrealized gains. So tax the value of a home even if you didn't sell it. Think about that. If you bought a home at $100,000 and it's worth $250,000 and you still own it, they're going to tax you. This is crazy. And they can do that with certain, like I said, certain types of structures. Excuse me. The president has also proposed raising levies on corporations and increasing the enforcement budget of the Internal Revenue Service. The more that advisors to wealthy examine Biden's proposal, the more they are realizing how significant the changes could be. Quote, what they're doing is creating a whole new tax regime. This is Richard Greenberg, a lawyer at Greenberg and Schulman, based in Woodbridge, New Jersey. Went on to say, quote, we're going to have to do a lot of reexamination of a lot of techniques. And that means not just reconsidering future planning, but looking at what we've done in the past for clients. Unmentioned by the White House so far are any changes to the United States estate and gift tax, a levy of as much as 40% affecting only very large fortunes that was created more than a century ago to break up dynastic wealth. But by targeting the powerful tools that allow the rich to avoid the estate tax entirely, the Biden administration may end up causing an even bigger headache for wealthy families. All right, so While the wealthy and their advisors wait for the details of Biden's tax package to firm up, there's little they can do except worry how the provisions might affect them. So, yeah, worry. Panic. So, general explanations of the administration's fiscal year 2022 revenue proposals. Okay? So, on page 62, gain on unrealized appreciation also will be recognized by a trust, partnership, or other non-corporate entity that is the owner of property if that property has not been the subject of a recognition event within the prior 90 years, with such testing period beginning January 1st, 1940. The first possible recognition event for any taxpayer under the provision would thus be December 31st, 2030. What else we got here? Payment of tax on appreciation of certain family-owned and operated businesses would not be due until the interest in the business is sold or the business ceases to be family-owned and operated. What else we got? Under the proposal, the donor or deceased owner of an appreciated asset would realize the capital gain at the time of the transfer. For a donor, the amount of the gain realized will be the excess of the asset's fair market value on the date of the gift over the donor's basis in that asset. For a decedent, the amount of gain will be excess of the asset's fair market value on the decedent's date of death over the decedent's basis in the asset. That gain would be taxable income to the decedent on the federal gift and or estate tax return or on a separate capital gains return. The use of the capital losses to carry forwards from transfers at death would be allowed against the capital gains income and up to $3,000 of ordinary income on the decedent's final income tax return, and the tax imposed on gains deemed realized at death would be deductible on the estate tax return of the decedent's estate. Okay, so I'm just going to break this down for y'all. They're talking about living trust. They're talking about grantor trusts. They're talking about this, and the key word I'm going to point out is they're talking about statutory trusts. Unequivocally. A transfer would be defined under the gift and estate tax provision. However, for purposes of imposition of this tax on appreciated assets, the following would apply. First, a transferred partial interest would be its proportional share of the fair market value of the entire property. So basically, if the property was owned by more than one person, and the partial interest in the property that was owned by one person was transferred, that would be the proportionate interest. Second, transfers of property into and distributions in kind from a trust, partnership, or other non-corporate entity other than a grantor trust that is deemed to be wholly owned and revocable by the donor would be recognition events. The deemed owner of such revocable grantor trust would recognize gain on the unrealized appreciation in any asset distributed from the trust to any person other than the deemed owner or the U.S. spouse of the deemed owner, other than a distribution made in discharge of an obligation of the deemed owner. They're telling you right there, a grantor trust. And most people aren't going to pull up the whole document and read through it. It's 114 pages, and they do that on purpose, y'all. But, too bad for them. They taught me how to read. And it was over. It was over after that. They should have never taught you how to read. That's, hey, y'all should have never taught me how to read. That's how I feel about it. Too bad. All of the unrealized appreciation on assets of such a revocable grantor trust will be realized at the deemed owner's death or at any other time when the trust becomes irrevocable. When it becomes irrevocable, what if it is irrevocable in its inception? They don't say nothing about that. And I wonder why. Certain exclusions would apply. Transfers by a decedent to a U.S. spouse or to charity would carry over the basis of the decedent. Capital gain will not be recognized until the surviving spouse disposes of the assets or dies. An appreciated property transferred to charity would not generate a taxable capital gain. Of course not. It's donated to a charity, and charities are tax exempt. I mean, the transfer of appreciated assets to a split interest trust would generate a taxable capital gain. Split interest trust. There's over 80 different types of trust, y'all, with an exclusion allowed for the charity share of the gain based on the charity share of the value transferred as determined for gift or estate tax purposes. The proposal would exclude from recognition any gain on tangible personal property, such as household furnishings and personal effects, excluding collectibles. The $250,000 per person exclusion under current law for capital gain on a principal residence would apply to all residences and would be portable to the decedent's surviving spouse, making the exclusion effectively $500,000 per couple. Finally, the exclusion under current law for capital gain on certain small business stock would also apply. In addition to the above exclusion, the proposal would allow a $1 million per person exclusion from recognition of other unrealized capital gains on property transferred by gift or held at death. The per person exclusion would be indexed for inflation after 2022 and would be portable to the decedent's surviving spouse under the same rules that apply to portability for estate and gift tax purposes, making the exclusion effectively $2 million per married couple. The recipient's basis in property received by reason of the decedent's death would be the property's fair market value. And those of you who are seasoned trustees in training, y'all already get what I'm saying. It probably already clicked by now, just by me reading this. I ain't even really saying nothing, just reading it. We're leaving like blah blah. Payment of tax on the appreciation of certain family-owned and operated businesses. Additionally, the proposal would include other legislative changes designed to facilitate and implement this proposal, including the allowance of a deduction for the full cost of appraisals of appreciated assets, the imposition of liens, the waiver of penalty for underpayment and estimated tax to the extent that underpayment is attributed to unrealized gains at death, the grant of a right of recovery of tax on unrealized gains, rules to determine who has the right to select the return filed, the achievement of consistency in valuation for transfer and income tax purposes, coordinating changes to reflect that the recipient would have a basis in the property equal to the value on which the capital gains tax is computed, and a broad grant of regulatory authority to provide implementing rules to facilitate the transition to taxing gains at gift, death, and periodically. Under this proposal, the Secretary, and this would be the Secretary of the Treasury, would be granted authority to issue any regulations necessary or appropriate to implement this proposal, including rules and safe harbors for determining the basis of assets in cases where complete records are unavailable. Reporting requirements for all transfers of appreciated property, including value and basis information, rules where reporting could be permitted on the decedent's final income tax return. So, look, what are they saying? What is this? What is this saying? First and foremost, don't cry, dry your eye. They're talking about grantor. They're talking about statutory trusts. They're talking about statutory trusts. 100%. 100% statutory trust. (100% statutory trust). A statutory trust is a trust that owes its existence to legislation. They are not talking about contract entities. They can't. And they're talking about dynasty trusts. And what is a dynasty trust? According to Wikipedia, a dynasty trust is a trust designed to avoid or minimize estate taxes being applied to family wealth with each subsequent generation. By holding assets in trust and making well-defined or even no distributions to beneficiaries at each generation, the assets of the trust are not subject to estate, gift, or generation skipping taxes. Moreover, the wealth can be exempt from generation skipping taxes if properly set up. By its nature, a dynasty trust can run in perpetuity. Thus, it must be created in a state that either has no rule against perpetuities, such as Delaware or South Dakota, or has a very long perpetuities period, such as in Nevada or Wyoming. Dynasty trusts in the United States were created as a reaction to the imposition of the generation skipping transfer tax on trusts. By keeping assets inside a trust for an extended period of time, wealthy families can bypass taxes for several generations or even forever. This effect has been compounded by other favorable state laws that favor the wealthy, such as the elimination of the state income taxation and other favorable conditions for managing wealth, such as quiet trusts and asset protection. In 2018, as a result of the doubling of the generation skipping tax exemption by the Tax Cuts and Jobs Act of 2017, very wealthy families in the United States seeking to shelter their wealth from future transfer taxes have taken a new interest in setting up dynasty trusts. As of January 1st, 2020, the generation skipping tax exemption is $11.5 million per person, and twice that for a married couple. Because the exemption, which is the highest ever, is scheduled to sunset January 1st, 2026, and could be repealed sooner depending on the next election. The interest in dynasty trusts is steadily rising, just as it did in 2011, when there was a risk that the generation skipping tax exemption could be severely reduced. Okay? They're statutory trusts, y'all. There's over 80 different types of trusts, is what I say all the time. 80. And if you know the principles of trust, if you know the principles of structures, whether they're private or public, it is easily you can just very simply discern what is being spoken on. And I will sit back and say all the time, I don't care what the quote U.S. government does or passes with regards to legislation. The way that my private estate is set up is private. The entities within my family's private estate do not owe their existence to any state legislation. Any, none, zero. They are specifically contract entities. They only come under trust law on how the income is dispersed and how the income is taxed. In all other situations, we're dealing with a contract. Contracts are protected by the Constitution. No state can pass any law against the obligation of contracts. There's a difference. An attorney, you go to an attorney, maybe you're wealthy. You're a millionaire. You don't know any better. You go to an attorney. Say, hey, I need to, protect my wealth. They set you up in a grantor statutory revocable trust, which does not protect against creditors, litigation, and only protects against probate. All the income from that entity must be reported on an individual tax return. It's an alter ego. It's not a separate, distinct entity. Set you up with some dynasty trusts that are statutory in nature, and you think you're none the wiser. You think everything's all good. You don't understand that a grantor trust is an alter ego. Any type of trust that is set up according to state legislation owes its existence to that state and is therefore governed by that state and is governed under federal statutory laws with regards to statutory trusts. Statutory, positive law, public. Statutory equals public. Legislative equals statutory equals public. You're gonna go to the attorney. They're gonna set you up with a trust agreement, not a trust contract. There's a difference. It's a glaring difference. And I know trustee training here at the foundation is not cheap. It's definitely not. Some would say, and I've heard people say, that it is cost prohibitive. But hey, paying taxes every year at exorbitant rates is not cost effective as far as I'm concerned. But this is not only what you learn in trustee training, but we learn how to properly administer these private contractual entities so that it doesn't fall under any type of legislation such as what I just broke down to y'all. We understand the difference between a statutory trust and a non-statutory trust. And we understand that regardless of what laws are passed, no state can pass any law impairing the obligation of contract. Article 1, Section 10 of the United States Constitution. Contract makes the law. So, I know there's trustees out here, they're in trustee training, and, they're thinking, oh, man, now there's going to be a problem with the trust. There's a problem. There's a problem with my state, my private estate, because, Biden's passing laws. I understand the initial fear. I can understand that. What I can't understand is that in your mind, you are unable to work through that fear by acquiring the knowledge that is specific to your specific situation. If you are a trustee in training here at the foundation, in private trustee training. People outside of that, okay, fine. But this article was sent to me. It wasn't the same article. Similar articles were sent to me by three separate trustees from trustee training. And I'm going to tell you this. You cannot learn this information by just picking up the phone and listening to someone talk. You cannot reasonably expect to be able to administer a private estate by just listening to people talk, man. In the same sense where Yusuf will tell you, you ain't going to learn how to set off debt by just watching videos. You want to be reassured. Why do you want to be reassured? Because you don't necessarily understand the difference between public and private. And I say it all the time. No state can pass any law impairing the obligation contract. No state. None. Zero. That includes the Department of State. So, that's what I have to say on dynasty trusts and the implication of the tax overhaul that the president of the United States is attempting to push through Congress. The trustees. The trustees of the United States, the trustees of the Constitution, technically. So let that be known. You got to understand the difference between a simple trust, a grantor trust, and a complex trust. You got to understand the difference between a statutory trust and a contractual trust. And people say, yo, so I heard you know about the common law trusts. What? Let's get specifically technical. There's no such thing as a common law trust. There are private contractual trusts that are executed under the common law right to contract unlimited. Being able to contract unlimited is a common law right. So with that common law right, individuals will execute contracts and administer them as trusts in the way that the income is dispersed and in the way that the income is taxed.
90 seconds.
Man, she's loud in my ear. Y'all heard that? I heard it. Got about 90. It's less than that now. About a minute and 15 seconds left in the broadcast. If you're checking out the show online, you want to call in 563-999-3625 if you want to catch the end of the show. If not, cool. You can catch it in the archives, players. So to answer the question, just very simply, quickly, will Biden's new tax plan threaten trust? Yes, it will. Statutory trusts, trust agreements, absolutely. Dynasty trust, yep. Generation skipping trust, yep. Spendthrift trust, yep. Grantor trust, yep. Simple trust, yep. Will Biden's new tax plan threaten the trusts that I am learning to administer in the private trustee training? No, unless you are not properly administering the trust. Then yes, you can definitely have an issue due to improper administration. Absolutely, 100%. So, it's something to be aware of. It's 100% something to be aware of. I understand. And it's the duty. It's the duty of the public, in my opinion, to, scare the mess out of people. Make you feel like there's no other choice. You have no other choice. You can't do anything. We're going to do this to you. We're going to do this to your estate if you get some information. There's no way you can hide. Ha, ha, ha. We got you. It's a psychological warfare, psyops, psychological operations. But in reality, once you understand the principles of public and private, you will know, no matter what is said, no matter what legislation is passed, what new rules or positive law that they put out here, that if you're properly administering your private estate using private contractual entities, no state can pass any law impairing the obligation of contract. Period. They talking about new money, not dynastic wealth, money that's been around for 100 years, 50 years. No, it's people who made their money off the .com boom recently. They call it new money. There's old money and there's new money. This applies to new money. You got some bread. You went and saw an attorney that set you over to a trust agreement. You're supposed to do this, supposed to do that, but it's subject to legislative control. Oops. The old money, I already know the deal. Hands down. And those who, either are informed or come from informed families. Because there's two different types of financial information available in this country. The majority of us get what is called controlled knowledge. It's what the public wants you to know. And some of us either come from informed families, so we get what is called true knowledge, or along the way, somehow, through seeking, you find someone who can educate you on true knowledge, aka real information, the real stuff, not the stuff that is put out to keep you in a box or enslave you. No, it's the stuff that frees you. And, as far as I'm concerned, it's a beautiful thing. It's 100% a beautiful thing. So, hey, with that being said, let me see, is there anybody in the phone lines? Because if not, I'm out of here. I appreciate y'all checking out the show, though. I trust that I was able to answer some questions. I trust I was able to shed some light upon, what's going on. Shed some light upon, the structures that we use here at the foundation, are educated upon in trustee training, and the differentiation or demarcation between these structures and other structures. I say it all the time, there's over 80 different types of trust. 80. But all you really have to know is the difference between public and private. Period. Public and private. That's it. And anytime someone says something to you, it will take you a very short amount of time to determine whether this structure is a public structure or a private structure. And once you're able to categorize the structure, you can definitely be able to determine how it's governed. And if this specific action or act of Congress or whatever, applies to that specific structure. To me, it's very simple. It's 100% simple. So, hey, with that being said, I appreciate y'all. Hey, I'm out of here. I appreciate y'all checking out the show, whether live or archived. I encourage you to email me, admin@welcometothefoundation.com, to inquire with regards to trustee training if you so desire. Also, check out welcometothefoundation.com, PDF section, Trust Series, Trust Primer, Passport No Social, book a consultation, make a donation. Whatever, at your leisure. These I offer, I don't sell. There's no sales, pitches, or anything like that. If you checking this out, you one of them seek and you shall find type people. So it's up to you, 100% up to you. I just wanted to alleviate any of the stress that was going through people's minds because they're putting this stuff on the news. They're putting it in news sites. They're putting it on news channels, and they're trying to spook people. And ultimately, it's a situation where, there's nothing you can do to get away from us. So you ultimately give up. Oh, there's nothing I can do. Because if you stop looking, you won't find. So that's what I had to say, That's definitely what I had to say. So, with that being said, I do want to say that I appreciate y'all. And, last week I didn't do the show. It's rare that I don't do a show. Everything's fine. People will hit me up. Are you okay? I'm fine. You don't usually miss shows, I know. Everything's fine. I'm all good. Yeah. But I definitely appreciate the concern. And, y'all have a great week. I really will y'all to have a wonderful, wonderful, luxurious week. Do your own research. Email me if you want to get up in the training, or if you just want to do a consultation. Just book a consultation. I think it's relatively inexpensive. But, that's just me. But admin@welcometothefoundation.com. I'm at your service. And, welcometothefoundation.com, that's the website. So with that being said, y'all enjoy yourself. Take care of yourself. Make sure you say 10 things that you're thankful for before you go to sleep tonight and every night, as it is very important. 100% important. And I will catch y'all next week here on High Frequency Radio Network for another episode of The Foundation. As I said, take care of yourself. Enjoy yourself. Peace to the gods.
Doing this thing all the way live. High Frequency Radio.